While most investors are still chasing traditional stocks and bonds, the ultra-wealthy are quietly moving into tangible assets that can't be printed away by central banks. Welcome to the world of uncommon asset classes designed to hedge against inflation and currency debasement. Today, we're exploring 5 strategies the elite are using right now to protect their wealth through scarcity and physical value. Let's start with high-altitude water rights. This might sound obscure, but water is becoming the new oil. In the western United States, water rights attached to land at elevations above 8,000 feet are increasingly valuable. Here's the math. A typical senior water right in Colorado or Wyoming that allocates 1 acre-foot annually, that's about 326,000 gallons, trades between $15,000 and $40,000 today. But here's what matters for inflation hedging. Water demand grows with population, while supply stays fixed. Over the past decade, these rights have appreciated 3 to 5% annually, completely independent of stock market cycles. When you own a water right, you own a legal claim that cannot be devalued by monetary policy. The government can't simply print more water. Some institutional investors are now acquiring entire portfolios of water rights across multiple Western states, treating them like a diversified bond replacement. That investment approach actually produces tangible value through agricultural leasing or municipal contracts. Now let's talk about vintage logistics machinery. This is where industrial nostalgia meets hard assets. Original Caterpillar D-Series dozers from the 1960s and 70s, or vintage Peterbilt heavy haulers, are appreciating faster than most understand. A fully restored 1972 Cat D9 dozer can sell for $180,000 to $220,000 today. 5 years ago, those same machines were selling for $90,000 to $110,000. That's roughly 15 to 20% compound annual appreciation. Why? Because manufacturing is reshoring, infrastructure spending is accelerating, and these machines are genuinely scarce. You can't manufacture 1972 anymore. What's crucial here is that this asset class doesn't correlate with equity markets or Fed policy. When inflation spikes, construction projects accelerate, and demand for vintage equipment increases, and prices follow. The wealthy are acquiring these machines through specialty dealers and leasing them back to construction firms, generating steady cash flow while the underlying asset appreciates. It's tangible inflation protection with yield attached. The third strategy involves lithium-brine royalties. This is where things get genuinely sophisticated. Lithium-brine deposits exist beneath salt flats in Argentina, Chile, and now parts of Nevada. A lithium royalty is a percentage claim on production revenues from these deposits. Here's the calculation. A brine operation in Argentina's Atacama Desert might produce 30,000 tons of lithium carbonate equivalent annually. At current spot prices around $15,000 to $18,000 per ton, that's $450 million to $540 million in gross revenue per year. A 5% royalty on that single operation generates $22 to $27 million annually. The math compounds further because lithium demand for batteries is growing 15 to 20% yearly. Unlike owning physical lithium, which requires storage and security, royalties give you the cash flow benefit. You get income streams without the operational headaches. Institutional investors are acquiring partial stakes in producing royalties through structured deals, treating them as inflation-resistant income streams that grow with industrial demand rather than monetary conditions. Our fourth uncommon asset class is fine art and rare collectibles tied to industrial heritage. We're talking about original technical drawings, prototype machinery, and mechanical sculptures from 20th century engineering firms. A signed blueprint set for a famous bridge or locomotive can appreciate substantially because scarcity is absolute. These items generate genuine emotional value alongside investment returns, making them less vulnerable to liquidity crises. They also exist outside traditional financial markets, adding portfolio diversification that truly means something. If you like exploring unconventional wealth strategies, please like this video because we're breaking down information the mainstream financial media completely ignores. Finally, there's agricultural land futures in climatically stable regions. But not just any farmland. We're talking about verified organic certification with water rights already attached. The math here is straightforward. Productive agricultural land appreciates 2 to 4% annually while generating lease income. That lease income is also 2 to 4%. That's combined returns of 4 to 8%, completely disconnected from stock markets. When currencies debase, food prices spike, and land value follows. The ultra-wealthy are quietly acquiring this across Southeast Asia, Eastern Europe, and North America. What ties all 5 of these together is that none are correlated with traditional equity markets. They're tangible, scarce, and produce real economic value. When you own water rights, you're protected against drought and population growth. When you own vintage machinery, you're protected against supply chain disruption. When you own lithium royalties, you're protected against energy transition dependency. Each works as insurance against specific inflation scenarios. The key insight is that the wealthy stopped treating inflation as something to endure. They started treating it as something to profit from. By moving capital into assets that can't be devalued by monetary policy, they've essentially hedged against currency debasement itself. This is the real portfolio diversification strategy happening at institutional level right now. The wealthy understand that traditional diversification, stocks and bonds, fails during inflationary periods. But when you own actual scarcity, actual production, and actual tangible value, your wealth survives currency debasement. If you found this breakdown valuable, please consider hitting that like button again. Subscribe for more deep dives into how the wealthy actually build and protect their fortunes. The strategies we've covered today: water rights, vintage machinery, lithium royalties, collectibles, and agricultural land, represent billions in capital reallocation happening right now. These aren't theoretical concepts. They're actively traded, actively priced, and actively generating returns for institutions that understand inflation hedging beyond stock picks. The distinction between ordinary investors and the ultra-wealthy often comes down to understanding what actually holds value. When monetary policy becomes uncertain, tangible scarcity becomes certain. That's the fundamental logic driving every strategy we've discussed today.